Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. This video is going to be part 2 of my 3-part series titled A Primer on Valuation. And in this video, I'm going to cover several examples of how earnings growth drives shareholder returns in the long run. Valuation based on fundamentals is what the focus of this video is all about. Because to prudently answer the question of when to buy a stock, an investor first needs to know the value of the company behind the stock. At the most basic level, a company derives its value based on the fundamentals behind the business it operates. Focusing on and calculating the fundamental value of a company lies at the core that differentiates the investor from just a rank speculator. Investors want to know what the business is worth and where its value comes from, past, present, and future. Speculators, on the other hand, are mainly interested in the price of the stock and typically only concerned with its recent movements. Short-sighted, to my way of thinking. As I mentioned in part 1 of this series on valuation, Ben Graham often extolled the virtues of investing over speculating. In part 1 of Common Sense Investing, the papers of Benjamin Graham, written by Ben Graham, courtesy of Value Hunter, Ben started with a discussion entitled Investment versus Speculation. The first paragraph summarizes his thoughts on this important matter, and I believe that Ben's basic ideas hold true today and are, quote, one of the disastrous consequences of the new era madness in Wall Street has been the disappearance of the former clean-cut distinctions between investment and speculation in common stocks. Old-time investment, with its emphasis on book value and the past record, was short-sighted and naive, but it possessed the supreme virtue of moderation. Present-day investment, as practiced by investment trusts and everyone else, is not much more than an undisciplined wagering upon the future, and as such, logically indistinguishable from speculation. If it's true that a company gets its value based on fundamentals, and I believe it is, then analyzing and evaluating the fundamental value of the common stock the investor is interested in purchasing should be of paramount importance. Furthermore, having a sense of how well a company has performed on an operating basis should provide great insight into the value it can provide to its shareholders. Unfortunately, most information provided to prospective investors focuses almost solely on price. Therefore, to paraphrase an adage, investors today know the price of every common stock and the value of none of them. Calculating the fundamental value of a business has typically been a very arduous and time-consuming task. The investor is required to pore over complex financial statements and reports to glean the necessary information from which they can make an informed judgment or decision on valuation. Perhaps this is one of the primary reasons why so few investors have been up to the task. Most sane people would rather find this process too tedious and boring to even contemplate, let alone conduct or do. Even though the fundamentals are vital and necessary to make an informed decision, the job is really just too complicated and or tedious for most people to desire. FastGraphs provides essential fundamentals at a glance. Because this research tool was developed to make it easier for prospective investors to ascertain the fundamental value of a business that they were interested in investing in. FastGraphs draw a picture that displays essential fundamentals at a glance, but they are not meant to be the final word in the due diligence process, rather the starting point. However, they are designed to provide an insightful perspective of just how well a company has historically been managed, to include how the market has generally evaluated the company's operating performance. This is what we label the normal PE ratio, which is a trimmed average of the market PE ratio. This powerful research tool has been programmed to extract the essential fundamentals behind each publicly traded business and provide an easy-to-review graphical interface between price and fundamentals. Most importantly, the primary focus of FastGraphs is on the company's earnings and or cash flow power, and then determining a fair value to apply to those earnings or cash flows, utilizing a discounted cash flow approach. Each company's earnings per share is plotted, and the growth rate of those earnings are calculated for any time frame that the investor chooses to review. This can be as short as the last 2 or 3 years or all the way out to the past couple of decades. I strongly recommend that users run various time frames to determine whether growth is accelerating, decelerating, or remaining constant. The estimated growth rate provided by leading analysts established a discount rate from which those expected future cash flows are discounted by. The central idea is to determine a fair and reasonable valuation that can and should be applied to each company under review. A fair valuation, which I like to call true worth, is functionally related to the rate of change of earnings growth the company achieves. In part one of this series, I focused on low growth companies, 0% to 5%, and applied Ben Graham's famous formula to calculate true worth. However, for companies that have moderate growth, which I define as ranging between 5% and 15%, I apply a modified version of Ben Graham's formula. The following examples look at several companies and their stock price correlated to earnings growth through the lens of the FastGraphs research tool. I'm going to compare several sets of two companies, each that have very similar fundamentals statistically. My goal, however, is to illustrate how statistics alone do not often tell an adequate story to make a learned decision. I'm first going to present the fundamentals only, which will display earnings and dividends. Then I will overlay weekly stock prices to illustrate how stock prices follow or correlate with earnings over the long run. The important distinction with these fast graphs is the focus on fundamentals first and stock price secondarily. This contrasts with most stock charts, including ones dealing in technical analysis, whose primary focus is on short-term price and stock price movement. My contention is that looking at price alone provides a lot of information, but no real knowledge or wisdom. I believe that true wisdom occurs when stock prices are viewed in relation to the fundamental value of the business. Therefore, a perspective of whether a company is overvalued, undervalued, or fairly valued becomes readily apparent. And when information is presented in this way, I believe the investor can possess the wisdom to make truly informed and therefore sound investing decisions. Of course, not every decision will be perfect because investing is not a game of perfect. On the other hand, most decisions will be more prudent when valuation is taken into consideration. That I'm going to be presenting. The first fast graph in each set of two will display earnings and dividends only. The green shaded area shows earnings. The light green shaded area depicts dividends paid out of those earnings. The orange line represents true worth based on valuing the earnings under a modified version of Ben Graham's formula that deals with moderate growth rate stocks. The earnings growth rate, the GDF ... PEG modified Ben Graham formula, PE ratio, and the debt-to-equity ratio are listed to the right of each graph. The next set of graphs will add two additional but very important lines. The black line represents weekly closing stock prices, and the royal blue line represents the calculated trimmed market PE ratio that the market has historically applied to the company's price. Included with this set will be a calculation of performance results for each company over the time period measured. Note that there is some forecasting in these charts which are not included in the return calculations. The most important takeaway from these calculated performance results is to be able to observe just how closely capital appreciation correlates to earnings growth adjusted by valuation. A brief commentary will be provided on each graph for clarification. However, please know that time and space restraints do not allow me to provide in-depth analysis on each company. There are two primary purposes behind this video. First, I illustrate how important fundamentals are to valuation. Second, my objective is to illustrate how earnings drive shareholder returns over the long run. In other words, capital appreciation will equate to earnings growth adjusted by valuation discrepancies. Also, note how dividends represent icing on the cake, so to speak, and will add to the total return. The first stock I'm going to look at is Target Corporation. And what I want you to notice about Target is the semi-cyclical nature of the company's earnings as depicted by this orange line. This orange line represents a PE ratio of 15 times earnings, which is a standard PE ratio that we've talked about many times. Ben Graham even stated that you should never pay more than 15 times earnings. Our contention is that a 15 PE ratio represents a fair value reference line that can guide you in making sound long-term prudent decisions. Now, Target in this iteration time frame, which is 19 years, has averaged just under 7% earnings growth, 6.91%. And that's the slope of this line, if you will. And I want you to note that the 15 PE ratio and later when I add the normal PE ratio, correlate very closely with how this company operated as a business. So let's go ahead and add weekly closing stock prices. And what you clearly see here is how stock price relates to that orange line, and how earnings rise, stock price rises strongly. When earnings collapse, stock prices collapse. You can also very clearly see periods where valuation is low, which becomes opportunistic times to buy the stock. And you also clearly see where valuations are high, which are less than optimum time. For example, if you'd have bought this stock on April 24th, 2015, and held it through July 28th, 2017, you'd have actually lost double-digit returns. Your 10,000 would have shrunk to 6,700 over this 2-year time frame, and even dividends didn't help you. On the other hand, if you'd have bought the stock when valuation was more in line with that 15 PE ratio and held it for the next 2 years roughly, you would have at least made a positive rate of return on your money. You can see that valuation matters, and it matters a lot. High valuations are less than opportune times to buy. Low valuations are primary times to buy. Even when the company just trades at fair valuation, you can make unbelievably large rates of return, like 30%. And I want to emphasize that you've done this with significantly less risk. The next line I want to add is the normal PE, as I mentioned. And I want you to note that the normal PE and the orange line PE ratio are almost superimposed here, or identical. In other words, a 15 PE ratio really would have served you extremely well as an investor in Target as a valuation reference, only wanting to buy the stock when it's below 15 and being reluctant to buy the stock when the PE was above 15. The next stock in this category of moderate growth, 7-ish%, will be Amdocs Corporation. And here, the same 19-year time frame, we see a much more consistent company. So this is what I meant when I said statistics don't always matter, but here you've got more consistency, approximately the same growth rate, 7.1 versus 6.9. But this company was much more consistent. You can also see that they started paying a dividend in 2012. But again, when I put weekly closing stock prices on the graph, you can clearly see how stock price tracks earnings and how important valuation is. During periods of high valuation, that can be very inopportune times to invest in the stock. If you bought Amdocs in October of 2015, when the PE ratio was above 15, 17.5, and held it to the low point where the PE was 13, you'd have only made 1.25% on your money. That's dead money for a long period of time. But you can also see how this fair valuation reference line really can guide you in making more profitable decisions. Buy it when the PE ratio is low and you participate fully in the growth of the company and beyond. That's the importance of valuation. Once again, when we apply the normal PE ratio, we once again see very clearly that 14 to 15 times earnings becomes a very, very credible value investment reference line. When the valuation is higher, it's less opportune. Now, you can still make money paying a high valuation for a company, but you end up participating less. Here you only got a 4.65% rate of return when the company was averaging much better numbers. Valuation matters, and it matters a lot. The next company we're going to look at is Cummins. Now, Cummins is a semi-cyclical company, but I want you to note that even with the cyclicality, it averaged about 10% growth. So here's a higher growing company, and yet we're still using a 15 PE ratio as our valuation reference line. But again, when I put weekly closing stock prices on the graph, we see how stock price tracks the results, the earnings results over time. When earnings get weak, the stock price gets weak. When earnings get strong, the stock price gets strong. And once again, with this tool in hand, we have a very clear perspective of opportunistic times to invest and less than opportunistic times to invest. Note how valuation always reverts back to the mean here. The stock price will be constantly seeking valuation, although it does not reflect fair valuation every point in time. That's a critical point to remember. And once again, when I put the normal PE, we see almost a perfect super synchronization here, around a 14 or 15 times earnings. Now, it's a valuation reference. It's not saying that this is the absolute fair value, but it's giving you a barometer, if you will, where you can know that you're making good decisions as long as the operating earnings you believe will be intact in the long run. And once again, if I buy the stock at a fair valuation. There's a little high at 15.98, and hold it. Here it was about 114.88. The earnings growth of 10.2% would have given us a 10.24% rate of return, very consistent with the growth rate, and add in dividends, and we end up getting about 11.5%. Valuation matters, and it matters a lot. The next stock we're going to look at in this list is Progressive Software. Now, it's about a 10% grower, 9.6%. And once again, when I put weekly closing stock prices, we see this correlation. We see periods of overvaluation. We also see periods of undervaluation, and it should become crystal clear when you're looking at this graph that the best time to buy the stock when the valuation was below a 15 PE ratio. That's really what this graph is depicting. And then when they start paying dividends, you even had a low period here. But once again, if I buy the stock at roughly a 15 PE ratio, more or less, and hold it to close to a 15 PE ratio, I get a rate of return of 9.83%, which is very consistent with the 9.6% that the company's earnings growth achievement. Add in dividends and I get better than 10%. Valuation matters. I buy the stock when the PE was very low, like I've got a 10 PE, and hold it to the 15 or roughly to about a 15 PE. I end up making 14 or almost 14, 13.48% a year. Valuation matters, and it matters a lot. Again, when I put the normal PE on, I see a range of 15 to 16 roughly times earnings. But again, I've got a very strong valuation perspective, and I can clearly see when valuations were high that I had poor results. When valuations were low, I had great results. Moving on, I did want to contrast all this. I did want to show a company that's kind of out of sync with what else I've shown you, but I do want you to understand how important valuation is. Here's Pitney Bowes, whose earnings have been dropping by almost 15% a year since the beginning of 2007. I also want you to note that they've cut their dividends several times due to this weakness in long-term operating results. And lo and behold, when I add stock price, we see during periods of weak earnings, we have very low valuations, but yet shrinking stock price. And we can see the stock price has collapsed along with fundamentals over this long time frame. The market PE has averaged about 12.5 here, but again, that's a valuation reference. We see a lot lower valuations during the time when the earnings really started to collapse and people got pessimistic. Then we saw just a little bit of breather in earnings here, only a 1% increase. The stock price recovered, but then as earnings continued to collapse, the stock price collapsed. Earnings determine market price in the long run, and a 15 PE ratio even becomes a good valuation threshold for shrinking earnings. But obviously, you never want to invest in shrinking earnings because your rate of return is going to be a function of the value you pay plus the future rate of change of earnings growth that the company achieves on your behalf. The next one I'm going to show is IBM here. And IBM is kind of a summary of what I've looked at so far. You see a period of time here where IBM's earnings grew very strongly from December of 07 even up through December of 14 or December of 13. And then earnings began to fall here as the company went through a transition phase. And then once again, of the last 2 years, earnings have begin to recover, double-digit in 22, 5% growth in 2023. Now, as you would expect, when I put weekly closing stock prices on the graph, during the strong period of earnings growth, the company's performance was very strong. And during the Great Recession, buying IBM and holding it through 2013 would have generated extraordinary rates of return. But then buying it in 2013 and holding it through where their last earnings collapse here, basically, you see that you end up losing money, negative 2.8% return. Your investment got almost cut in half, and again, even dividends didn't you back to even. Earnings determine market price. Now, the normal PE ratio here was, again, consistent with this 13 to 15 times earnings. Now, I'm using a 2.63% time frame. That's why I've told you it's so important to run different time frames, because if I adjust this time frame, we get totally different results. If I run this out to a max, we get that 3.5% growth rate. But the point I'm getting at is that the earnings growth and the earnings achievements are what's going to drive your return. Now, moving forward, if I go to Dover Corporation, another semi-cyclical kind of average growing company at 7.5%, I add weekly closing stock prices. Here's when nobody wanted to own Dover, and yet this would have been a tremendous time to be buying Dover, even if you held it out all this time and were willing to ride all these different roller coaster movements in the stock price. You end up with a very strong rate of return. You can see clear, very high valuation in the result, and you can see it's clearly overvalued again today. This was a 15 PE ratio as our valuation reference line. The normal PE was 14. And again, that gives you a very strong perspective of when to buy, when to sell, and when to hold a common stock by focusing on valuation first, stock price second. The next one here is FedEx, another average grower of 7%, a little more cyclical here, but once again, look how fundamentals drive stock price. When fundamentals were dropping, stock price fell. When fundamentals were rising, stock price rose. When fundamentals fell again coming into COVID and losing the Amazon business, stock price fell. Then when earnings recovered, stock price rose, and then when earnings fell again, they fell, and now as earnings are recovering, the company's price is following suit. Once again, we have this very clear 15.99 and 15 kind of valuation threshold. Again, it's not trying to be too precise here, but just clearly give you an idea. Like, is this overvalued at a PE of 20? Yeah, probably. Is this overvalued at a PE of maybe 16 and a half? That's probably fully valued, not overvalued. But I think you get the point. Going on to Raymond James, we're starting to approach that 15% maximum threshold growth rate. The company grew at 14%, but again, I want you to see the PE ratio. When I put the weekly closing price, look how perfectly the price almost followed the earnings at a 15 multiple. And then when I put the normal multiple, once again, the lines are almost superimposed, but we see very clear periods. But Raymond James was the kind of company you could have bought it almost at any point in time because the valuation of this stock always seemed to be in alignment with its operating results, which makes it a nice company. But again, if I buy it at a reasonable PE ratio and hold it to its current PE ratio of 14.1, I get 14%, I get 13.65% capital appreciation, which comes very, very close to the 14.11% growth rate. Valuation matters, and it matters a lot. So here we have a faster growing company that if you buy it at good valuation can generate really strong double-digit rates of return for you. Moving on, if I go to Elevance, once again we see 13.3% grower. When I put price on the graph, weekly closing prices on the graph, look how clearly they follow it and how the valuation reference lines guides us into making prudent and sound decisions. As long as earnings were growing as they were here, and you could buy it at this low PE when nobody wanted it, and that's in the throes of the Great Recession, even when the PE stayed low, you made almost 16% a year. I think that's important. But then, of course, if you'd have bought it here or somewhere near here and held it when the valuation got above 17 like it did here, you make almost 19% a year. Valuation matters, and it matters a lot. And once again, the normal PE ratio is very consistent with the 15 valuation threshold that I talked about several times. In summary and conclusion, I contend that the evidence is crystal clear as I've just shown you. Fundamentals provide a critical perspective that investors should be aware of. And possessing a clear and accurate picture of how well a business has performed on an operating basis is a vital component towards making sound and prudent investment decisions. But not only are they sound and prudent, but they also increase your rates of return in the long run. Because contrary to what some might argue, the fundamental operating results of the business do tend to persist. The nature of a company's business and the industry it operates on can be reliably evaluated and understood. Not perfectly, but very reliably. There are two quotes from the venerable investor Marty Whitman, chairman of the board of the Third Avenue Value Fund for many years, that nicely summarizes the main points of this video. The first deals with how much easier it is to determine the true worth value of a business than it is to guess what its stock price might do in the short run. And I quote, "I remain impressed with how much easier it is for us and everybody else who has a modicum of training to determine what a business is worth and what the dynamics of that business might be, compared with trying to estimate the prices at which a non-arbitrary security will sell in near-term markets." I think Marty was very wise with that quote. But his second and final quote of this video addresses the notion that fundamental values are actually way more important than short-term price volatility. Unfortunately, most people take their guide from price volatility while almost totally ignoring fundamental valuations. I obviously believe this is a mistake and humbly submit that the FastGraphs Fundamentals Analyzer software research tool can greatly assist investors in overcoming this area. Marty's next quote was, "Unrealized market depreciation occurs when the market price of a publicly traded security declines. Permanent impairment of capital occurs when the fundamental values of a business are dissipated with long-term adverse consequences." Again, Marty was a very wise man. But as I have stated many times before, I believe that measuring performance without simultaneously measuring valuation is a job half done. Finally, valuation matters, and it matters a lot, and I believe it deserves much more attention than it gets. Wise and prudent investors, understanding this, stand to earn higher long-term returns at lower levels of real risk as a result. Getting better returns at less risk is a holy grail of investing. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. Hope you enjoyed this video. If you did, give it a like. Subscribe to our channel if you haven't already. And for goodness sake, take a look at FastGraphs. What a marvelous way for you to be very confident in your buy, sell, and hold decisions of common stocks going forward. And even if you're willing to buy a stock at an overvaluation period, at least you're investing with your eyes wide open. Thanks for watching, and stay tuned for part 3, where I look at the fast above 15% growers and how Peter Lynch's famed formula, the PE ratio equal to the earnings growth rate, then comes into play with these kind of faster growing stocks. Thank you.